So you've heard it said that there are two things that all of us are going to have to face: death and taxes. And we're going to talk about the one that's probably the most heinous: taxes. You see, most people think about taxes while they're scrambling to collect documents and get them to their tax preparer or maybe log into their tax software. But the real pros are thinking about taxes all year round. So we're going to try to give you some tips today about what you can do to maybe make that a little less heinous next time. And I've brought Chad Roller from our Conway office today to join me and talk through this, because you and I have both had varying experiences with taxes throughout our journeys here at Gen Wealth and in our previous careers. And so I thought you'd be a good voice to kind of add to this conversation.
Yeah, and I'll be honest here. This is usually I prepare well for a lot of things, and I'm prepared and I stay ahead of a lot of tasks. This is one that I procrastinate. And I don't know why. It's always been one of those things that I feel like I'm always scrambling. And do I have everything that I need in the folder, right?
Well,
or in the box?
And you use a local CPA tax preparer. And so you really have to have everything sent in at the same time. See, I do my own. And so I have the benefit of being like, crud, I forgot that form. Let me go hunt it down real quick. And then I put it back up. I've got the dual screens going. So I have a little more grace than that, because you're having to make another trip if you've forgotten something.
Yeah, and I started, growing up, I had my own lawn business, so I was taking in income, and that was a little bit of different of being self-employed. And then as I evolved through college, I had some different occupations, and then once I got out of college, then I started into the real world, and I've had some transition of time when I had some 1099 income and W-2 income, some self-employment. So I've had a little bit of a mix of all of it. But it just seems like it doesn't matter what it is. I've always been
There's always some sort of monkey wrench in there.
Have I gathered everything, right?
Yes. And I think that extends even for my retiree clients. I've got several that I will create this little document that's like a checklist, because it is overwhelming to know what all you need, no matter what stage of life you're in. There's just a ton of stuff to organize and collect, and there's always something that ends up getting left off. And if you're having some sort of major life change, like marriage, divorce, new kids, things like that can change so much about your tax picture, even between a given year and the next one. So it is important to understand what that looks like. Now, I want you to grab a notebook if you haven't already, because we are going to talk about some strategies that could save you money and some steps that you can take to be better prepared. And, I want to make sure that you get these down. So if you haven't got your notebook, get it ready. We're going to start with understanding your previous tax return, because things can change, but you got to have a starting point.
Yeah, I think that's a great place to start, because that starts you in the preparation and the remembering back through those steps of what you needed to prepare for and what the results were of last year. So as we know, not year to year, everything's going to be exactly the same. If it was, this would be a lot simpler, right? And for some, it is, you've got basically kind of the same snapshot from year to year. But for most, you're going to have a little bit of variance. But starting with last year's tax return will kind of give you an idea of, okay, I remember that process. It's only been a year, but I remember that process, and now I can start preparing myself for this year.
And if you do keep all the documents in the same folder that your tax return was filed in, you can go through those documents and say, okay, I've got this one from this, I've got my mortgage statement here, and kind of match those documents up to make sure you still have the same documents, and then ask yourself, what, if anything, has changed, so you know what additional documents you might need. So that can work as kind of your starting point if you're panicking about getting all your stuff together, Chad.
Yeah, so once you getting started, right, you're starting to prepare, look at last year's. Now, what are you going to learn from last year? So did you get a big refund?
Right.
What was the results from last year? Did you make any adjustments to your W-4 this year?
And if people don't know what the W-4 is, that's the document you give to your employer that tells them how much to take out of your payroll. And I can tell you the form has complicated itself, as many legal documents tend to do. When I was younger, you would just say, I have X number of deductions, call it a day. Well, now it can get really messy. There was a situation a couple of years ago I was telling Chad about where my husband had marked on his that he had a certain number of deductions, but what they were basing the withholdings off of was purely his salary, which meant he paid very little into the federal government. And when we got ready to file taxes, we almost had to pay a big bill. Thankfully, we had a child credit that year that we didn't have the year before. That was the year Amelia was born. And so that kind of balanced it out, but it could have been ugly if we hadn't had that to offset it. So it is important to understand what happened, if anything has changed there. And by the way, if you got a big refund last year, you just gave an interest-free loan to the government. So you may want to consider shifting what's on your W-4 to get a little bit closer to breaking even. I don't encourage you to go to where you're going to owe, but if you did get a huge refund, might be time to throttle back just a little bit as long as things are the same this year.
Yeah. And one other thing is, if you did get a big refund, what did you do with it?
Yes. Were you intentional?
Is there a lesson to be learned from, okay, hey, I made a good decision. That's what I utilize it for. That's probably a good game plan for this year. Or, hey, I probably didn't utilize that for, the best practices throughout my financial journey. So what will I do this year if I get that return?
Yeah, because if you got a $2,000 return, that would have been roughly about $120 a month in your pocket that you could have used for one of your other financial goals if you work it out where you can not have to pay that in. So there are some things you can do. But let's talk about if you did pay in. It may be that W-4 was messed up, like the situation with my husband. He needed to add on there my income so that it was counting both of our incomes in that calculation. That may be the situation for you. Your state withholdings might not quite be where they need to be. Did your deductions change between last year and this year or the year before? Figure out what caused the bill so that you can plan ahead for it. I've had clients who had 1099 income and didn't know that they could pay quarterly taxes. And then when they did their tax return, they ended up owing a penalty because they hadn't paid enough. So, we talked to them about doing some quarterly taxes or encourage them to talk to their CPA about that. But if you did end up having to pay in, there are a lot of things that you might have been able to do to set yourself up to win. Another thing is if you have self-employment, you can track a lot of expenses and deduct them. But if you don't track them, it's a lot harder to be audit-proof. So you want to make sure that you're using some sort of tool to help you with that.
Yeah, and if you're a business and you paid in a lot and you want to say, okay, where are some of those tax savings? If I want to start an employer plan, you need to start it sooner and later because a lot of those plans need to be payroll deducted, right? It's not like getting to the end of the year and saying, hey, we're going to buy a big piece of equipment in a lump sum.
Yeah.
Typically, simple IRA contributions, we need to have those set up throughout the year and give you time to do those payroll deductions throughout the year.
Yes, and it allows you to tax defer some of that income as the business owner and match it as the business owner. So you've got a lot of things you can do if you can plan ahead. But we talked about this a little bit. Are your circumstances changing? We talked with one of our coworkers who, they went through a divorce and they didn't realize that your tax status when you're doing your filing is based off of where you were at the end of the year. So I was divorced several years ago in the middle of the year, but I had to file separately. Sometimes you can file jointly if you guys agree to it, but we filed separately that year, which meant that our tax situation was very different from the year prior. Well, someone thankfully encouraged me to go to my employer and adjust my withholdings when I was going through that divorce, and I did. But had I not done that, I could have ended up with a little bit of a tax bomb at the end of the year. So that's something to consider. If you have a baby, you've got a new deduction. Congratulations. By the way, they could have been born December 31st. You still get the deduction like you had them the whole year, unlike me who choose to have them at the beginning of the year, where I go the whole year. If you're starting a business, there's another opportunity for you. But you have to be responsible and really track your expenses and your deductions so that you can really claim them at the end of the year.
Yeah, and one of the things is, did you move jobs? And maybe if you had a loan on that 401k and you moved that 401k, then now that loan becomes taxable to you. So if you maybe took a distribution from a retirement plan, there's some of those circumstances that you may have forgot about.
Yes.
Or
and
we're not
aware
of.
Really impactful.
Yes. So those are some of the things that you want to make sure that things have not changed from the previous year.
And if they have, make sure you're planning ahead. As those things occur, plan ahead for what the impact might be. Another thing to think about is maximizing your credits and your deductions. I want to clarify the difference between the two before we go into that, because a lot of people don't understand. A deduction lowers your taxable income. So imagine I make $100,000 a year and I have a $5,000 deduction. I'm going to be taxed off of $95,000. So it just takes off the taxable amount. However, credits are a dollar for dollar reduction in your tax bill. So the difference would be, let's say out of that $100,000, I owed $15,000 in tax and I have a $3,000 credit. Well, now I'm down to $12,000 in tax. It's much more impactful on saving you tax money when you have access to credits. So understand what credits and what deductions you might have available and get the proper documentation there. So what are some deductible options, things that you can deduct? Charitable donations, daycare, mortgage loan interest, HSA, employer plan contributions. Those are two separate things, HSAs and employer plans. Real estate taxes, mileage for business expenses, tuition and fees for certain qualifying institutions, student loan interest payments. And there are a ton more. This is not an exhaustive list. So there are a lot of things that you can deduct if you qualify. Now, Chad, let's talk about those credits because, like I said, those are the ones that really impact your tax picture.
Yeah, the biggest one for me is the child tax credit. With having 3 children, so that one is very beneficial for our household.
Mm-hmm.
And then you've got the child independent care, the daycare, right?
Yep, which I listed that as a deduction, and I put it in the wrong category. It is a credit.
Yep. And then the savers credit. So elaborate a little bit on the savers credit because I'm not as familiar with this one.
You have to qualify for this one. So putting into your employer plan may qualify you for just like a flat credit. It is income dependent, so I don't believe I qualified for it last year. So it's one of those like you have to have a lower level of income, but they want to give you a benefit for putting into your employer plan, and so you'll get a flat credit if you qualify for that. And then higher education expenses, the lifetime learner credit is one that you may qualify for. It just depends kind of what, those are both income based. Really, all of the credits are income based. You have to meet those requirements. Another thing to think about when you're looking at deductions and credits is if you're entering a higher tax bracket and you want to avoid that, maybe making a donation to a charity or something that can deduct that back down might benefit you so you're not paying that higher level on those last dollars that you make. But overall, what we would recommend here is consult a CPA because they're going to be the real experts on what credits or deductions you may qualify for. So if you're not sure about that or how to track those, get started now. Have a conversation with somebody that can educate you and then implement the steps they give you to make sure you're tracking it throughout the year.
Yeah, and so one of the things that, as far as a truth, the taxes will tell you IRA, pre-tax or post-tax. And that's one that we deal with a lot. And setting down clients and understanding, okay, should I be using the pre-tax or should I be utilizing the Roth? And so that the tax return will help you decide, okay, do I need to take a deduction and utilize the pre-tax portion, or based off of what I'm earning, the credits, deductions that I already have, I'm kind of taking care of those taxes, so I may benefit from the long tax-free income from the Roth IRA.
Yes, so that's why it's important that you're analyzing that every year. And we've talked about this a little bit kind of in between categories here, but really one of the biggest things I'd encourage you to take from this is keep good records. I know it's time consuming sometimes, but there are apps now. There was an app when I was working, doing some self-employed things that I used that I could take a photo of receipts and it would store them for me and organize them and I could categorize them. All I had to do was hit start when I was going on a trip, end it when I got where I was going, and then I could categorize it and put a code in there. It did all the work for me and it only cost me $20 a year. So there's a lot of tools out there that you can use to keep records because if you're not audit proof, it could come back to bite you. There are a lot of people that will say, well, just deduct it. It'll be fine. Don't worry about it. And I always tended to be a little more timid on that because the IRS does not care if you made a mistake on accident. If it was unintentional, they're still going to penalize you for it. So if you can make yourself audit proof, that would be the best kind of use of your time, in my opinion, especially if you're self-employed and you've got all these deductions that you can take. Make sure you're keeping copies of things and really keeping good records.
And not only records for your taxes, but also where are you spending? Just your overall personal finance and understanding the difference between these deductions and credits and where am I spending? Am I spending a lot of monies, that are not beneficial to my business? And we see that a lot of times is, we think what we think may be a deduction or benefit to the business that we can pay doesn't always work out that way.
Yes, I've heard a CPA say it that, a lot of times business owners will spend $1 to save 25 cents on taxes. So that is definitely something to consider as a business owner especially. Well, it's time for our 2 cents. Chad, I'm going to let you go first.
So number one, we are not CPAs, right? But we do help clients understand the benefits of utilizing retirement plans pre-tax versus post-tax, and the tax return plays a big role in that. So understanding your tax return, not just understanding, oh, I've got to pay taxes or I'm waiting on a big refund, right? That's not the goal here, is understanding really what's under the hood and why you're doing what you're doing so you can benefit from utilizing your deductions and credits and your qualified retirement plans.
And I would say, we're kind of taught from an early age to hate taxes. I feel like that taxes are horrible. But I will say, it is part of earning income too. So yes, you want to be intentional about making sure you're not paying more than you have to. However, don't go into it with a negative attitude would be one of the suggestions I would make. Don't see it as a chore. Just see it as part of life. None of us want to go toe-to-toe with the IRS, so certainly make yourself audit-proof, but don't necessarily go into it with a bad attitude is kind of where I'm going with that. So thank you guys so much for joining us. If you like this content, we'd love it if you would share it and subscribe so more people can get access to it. We'll catch you next week. Thanks for listening to Talking Sense. And if you like what you hear, make sure and subscribe to the podcast to get all the newest episodes. The Jim Wealth team is available to you 24/7 at info@getreadyforthefuture.com or by calling our offices at 866-653-PLAN. That's 866-653-7526. And while we like to have fun here, we're also financial advisors, and that means disclosures. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and Jim Wealth Financial Advisors are separate entities from LPL Financial.